Imagine processing nearly $500 billion in a single 90-day window.
I mean, it's almost hard to wrap your head around that kind of number.
Right. It's just staggering. And if a business hits that kind of sheer volume, you would naturally assume the boardroom is in full celebration mode.
Oh, absolutely. Popping champagne, high fives all around.
Exactly. You'd think, you've conquered the market, your scale is basically untouchable, and you have effectively won the game. But,
Totally.
and this is a big but what happens when that massive, mind-boggling volume completely fails to translate into growing profits?
Yeah, that's when you end up with a very tense corporate reality. I mean, is there a scale most fintech startups can only dream of reaching, really? But the underlying mechanics are struggling.
Flashing some major warning lights, right?
Exactly. The actual engine driving the business is sputtering, even while the car is flying down the highway.
And that tension is exactly what we are dissecting today. We're taking a deep dive into the digital payments giant, PayPal.
The fascinating case study right now.
It really is. We have a massive stack of sources on the table to figure out what is actually going on under the hood here.
We've got their recent Q2 2026 financial reports, some pretty harsh analyst downgrade notes from Macquarie.
And valuation models from Morningstar, too.
Yeah, and some really fascinating insider trading filings that we'll get into later.
Right. Because the goal for you, listening to this, is to look at a tech pioneer, one of the original giants of the internet age, and see how it's handling relentless, well-funded competition.
It is the ultimate innovator's dilemma playing out in real time. We are looking at a company trying to pivot a legacy system, while the technological ground underneath them is just constantly shifting.
Yeah, let me set up a framework for how we should view PayPal right now, based on everything we read in these reports. Picture a massive ocean-crossing cargo ship.
Okay, I like this. A cargo ship.
Right, and it is still moving incredibly fast, cutting through the waves, carrying a record-breaking amount of freight. But if you walk down into the engine room, you realize the ship is somehow taking on water.
And the fuel costs are suddenly wiping out all the shipping fees they're collecting.
Exactly. So we need to figure out if this ship is structurally doomed, or if a new captain can just patch the hull and correct the course.
Well, to understand the water in the engine room, we need to move past the top-line illusions, right? We have to look at the Q2 2026 financial realities.
Let's put some numbers to that scale first, just to set the baseline.
Okay, so
in Q2 of 2026, PayPal's total payment volume, the actual amount of money flowing through their systems, hit $486.45 billion.
Which is up 10% year over year. That's not a small jump for a company that size.
Not at all. We're talking about 6.75 billion individual transactions. And consequently, their top-line revenue increased 5% to $8.68 billion.
Right, which actually beat analyst expectations.
Yeah. So if I just read the headlines, I'd assume the ship is speeding up and everything is fine.
But that is the trap of top-line metrics. The volume is undeniably massive.
Yeah.
But look at the bottom line.
This is where it gets ugly.
Very. Because while revenue went up 5%, operating profit actually fell 5%, landing at $1.4 billion.
Wow.
And net profit dropped even further. It was down 12% to $1.1 billion.
So they are moving significantly more money through the ecosystem, but less profit is actually sticking to PayPal's hand.
Precisely. Which brings us to the lie detector test of this whole financial report.
Transaction margin dollars, or TMD, right?
Yes, TMD. It's the most important metric for them right now.
Okay, so if I'm understanding the mechanics correctly, TMD represents the actual profit PayPal keeps from a transaction after paying off all the underlying costs.
Right, like the interchange fees they have to pay to Visa or MasterCard.
And any losses they take from fraud?
Right, that's the core of it.
Yeah.
Transaction margin dollars measure the pure fundamental profitability of moving money from point A to point B.
And what did that look like in Q2?
Well, in Q2, that metric grew by a measly 1%.
Just 1%?
Yeah.
On 10% volume growth?
Yeah. And it's actually even worse if we strip out the macroeconomic tailwinds.
Wait, what do you mean? What tailwinds?
We have to account for the interest PayPal makes on customer balances. Because interest rates have been relatively high, PayPal gets a free revenue boost just by holding customer cash.
Oh, right, because they sweep that cash into yield-bearing accounts, so it's not even money they made from their core product.
Exactly. If you strip out that interest income float, their core transaction margin grew just 3%.
Ouch. So the volume of money they're moving is up 10%, but the profit they make on moving that money is virtually stagnant.
Which causes the overall net profit to shrink. So mechanically, their unit economics are just getting crushed.
It really reminds me of a restaurant that is completely packed with customers every single night.
Oh yeah, like a trendy spot with a line around the block.
Exactly. The kitchen is frantic, the servers are exhausted. But at the end of the night, when the owner actually runs the numbers, they realize food costs and overhead have spiked so high.
That they're losing a few cents on every single meal they serve.
Right. So pushing more volume just means they lose money faster.
That restaurant analogy perfectly captures the unit economic squeeze they're in. The volume is there, but the profit per transaction is deteriorating.
So to understand why those margins are shrinking, we have to look at the competitive battlefield.
Yeah, we need to map out exactly where PayPal is losing ground and, surprisingly, where they are still experiencing massive growth.
Let's start with the traditional engine of the company, which is the branded checkout.
The classic PayPal button.
Right, the one you click when you're checking out on a merchant's website.
The branded checkout has historically been the absolute most profitable part of PayPal's entire ecosystem, but it's currently under intense, unrelenting pressure.
From Apple Pay and Google Pay, mostly.
Exactly. Deep-pocketed competitors. And the reason really comes down to user friction.
Yeah, because Apple owns the hardware.
They own the iPhone, they own the secure enclave, and they own the biometric prompt.
So to use Apple Pay, as a consumer, you just double-click the side button, scan your face, and you're done.
Right. It takes 2 seconds. PayPal, on the other hand, is just an app living on Apple's device.
So Apple essentially built a toll booth right into the operating system, and they have zero friction. You don't have to remember a password. You don't have to log into a separate browser window.
And that structural disadvantage is showing up glaringly in the data.
What are the numbers looking like there?
Well, in Q4 of 2025, PayPal's online branded checkout volume grew a concerningly low 1%.
1% for their core product.
Yeah. Now, to be fair, we did see a modest reacceleration to 5% constant currency in Q1 of 2026.
Okay, so 5% growth when you strip out the mathematical distortions from foreign exchange rates.
Correct. But even at 5%, that is a massive slowdown compared to their historical dominance.
So the high-margin core product is barely growing, but the sources highlight some massive bright spots in their consumer financial services, right?
Oh, absolutely. It's not all doom and gloom.
Yeah, like Venmo. Venmo's total payment volume grew 14%.
Which marks its 6th consecutive quarter of double-digit growth. That's huge.
And they have a newer feature called Pay with Venmo, which lets you use Venmo for actual retail checkouts. That surged 34%.
Plus, their buy now, pay later volume jumped 23%. So the younger demographic, the peer-to-peer ecosystem, and flexible credit options are just booming.
Vendo has incredible mindshare. Like, it's a daily verb for most people.
Yeah, the daily user engagement, it's off the charts.
But this is where the math stops making sense to me. Venmo's a verb, buy now, pay later is exploding. If these products have huge double-digit growth, why is the overall transaction margin still flat?
Because of the product mix shift.
Okay, unpack that for us.
Historically, peer-to-peer payments on Venmo, like, sending $20 to a friend for your half of dinner, do not generate any revenue for PayPal.
Oh, right, unless the user actively opts to pay a fee for an instant transfer to their bank account.
Exactly. So Venmo has incredible transaction volume, but much, much lower transaction margins than the classic PayPal branded checkout.
Got it. And the same dynamic has to be happening with Braintree, right? Their unbranded processing service.
Spot on. Braintree works in the background for massive enterprises.
But if you are processing payments for the biggest merchants on the planet, those merchants have all the negotiating leverage.
They absolutely do. They can demand rock-bottom processing fees, or they just threaten to walk over to a competitor like Stripe or Adyen.
So PayPal gets all this massive volume from Braintree, but they are making fractions of a penny on the dollar.
You've isolated the core problem. The parts of PayPal's business that are growing the fastest, Venmo and Braintree, are the least profitable.
And the part that is the most profitable, the branded checkout, is growing the slowest.
Yeah, the product mix is actively working against their overall margin profile.
To go back to the restaurant, it's like the cheap appetizers are selling out and keeping the kitchen slammed, but nobody is ordering the high-margin steaks anymore.
That is a perfect way to put it. And you cannot fix a fundamental product mix shift overnight.
Right, you can't magically force Apple Pay off of a billion iPhones.
You really can't. So management is pulling the one immediate lever they actually control, which is operating costs.
Right. New CEO Enrique Lars is putting the company on a massive $1.5 billion diet.
Which, Honestly, sounds a bit desperate to some analysts.
Yeah, I mean, you cannot shrink your way to long-term growth. The thesis here relies heavily on implementing AI and automation across the company, right?
Yeah, to make engineering, customer service, and compliance more efficient.
But looking at the analyst notes, Wall Street is not exactly throwing a parade for this cost-cutting strategy.
The skepticism is heavy. We need to look at the bear case perspective here, specifically highlighted by the research firm Macquarie.
They recently downgraded PayPal stock, didn't they?
They did, and their primary concern is that these AI-driven savings are heavily back-end loaded.
Meaning the math sounds great on an earnings call today, but the actual money doesn't hit the bank account for years.
Exactly. PayPal CFO Jamie Miller actually warned investors that there will be two distinct waves to this cost program.
Two waves. Because implementing enterprise-wide AI isn't like flipping a switch.
Right. You have to train the models, integrate them into legacy systems, and phase out human workflows really carefully so you don't break compliance.
So when do they actually see the money?
The really impactful wave of savings won't actually materialize and hit the bottom line until 2026 and into 2027.
And even when it does hit, it's not a pure 1.5 billion addition to profit, is it?
No, not at all. The notes mention that the net flow through to earnings per share, or EPS, might only be $500 million to $1 billion.
Wait, where does the rest of the money go?
Because in a hyper-competitive tech landscape, you can't just pocket all your cost savings.
Oh, they have to reinvest it.
Exactly. PayPal has to take a significant chunk of that $1.5 billion and reinvest it immediately back into marketing, product development, and engineering.
Just to tread water against Apple and Google.
Precisely. The tech treadmill never stops.
So management is essentially telling Wall Street, we are going on a strict, painful diet today to fix our margins, but the actual calorie burn and weight loss won't show up on the scale until 2 years from now.
That's the pitch.
But will the market actually wait until 2027 for a turnaround? Because the immediate guidance is brutal.
It really is. Q2 2026 EPS is guided to decline approximately 9% year over year.
And full-year EPS is expected to be essentially flat. If I'm managing a portfolio, tying up capital for 2 years while a legacy tech company tries to find its footing, that feels like an eternity.
And that timeline brings us directly to how investors are reacting right now.
Which is reflected in the stock's technicals and overall market sentiment, right?
Yeah, and the market is deeply conflicted. The stock is currently down over 25% from its 52-week high in October 2025.
Though it has shown a recent 13-week recovery, hasn't it? Bouncing up about 27% from its absolute lows in February 2026.
It has. But if you zoom out to a multi-year chart, it remains trapped in a structural pattern of lower highs.
I want to dig into the insider trading signals, because the data here is fascinating but also incredibly contradictory.
It's one of those interesting parts of the report.
So we have net insider buying. Executives and board members at PayPal have bought almost 900,000 more shares than they've sold in the last 90 days.
Which on the surface looks like a massive vote of confidence. The people running the ship are buying equity.
Right. But then the data introduces a metric called the mean sentiment price ratio, or MSPR.
And that ratio is heavily negative.
Yeah, at negative 23.24. So how can insiders be buying 900,000 shares, but the sentiment ratio is deeply negative? Walk us through the mechanics of that.
It's a great question. The mean sentiment price ratio looks beyond just the volume of shares bought. It analyzes the specific price points at which insiders are executing these trades.
Okay, so what does the negative 23 mean?
A negative ratio of 23.24 means that while insiders ended up buying more shares overall, they were aggressively selling their stock when the price was higher.
Oh, I see.
And they only started buying when the stock plummeted to its absolute rock-bottom lows.
Ah, so this isn't a high conviction. We are about to take over the world buying spree.
Not at all. It's opportunistic bargain hunting.
They are buying the floor because they think it mathematically can't go much lower, not because they're chasing a new ceiling.
Exactly. It signals a belief that the stock is oversold in the short term, rather than a sustained belief in rapid future growth.
And that brings us to the valuation itself, which is where things get really polarizing. PayPal is currently trading at a price-to-earnings ratio of just 10.21x.
Which is wild. For a massive technology and payments company, 10 times earnings is practically unheard of.
Right, that is legacy bank territory. The research firm Aardvark Labs upgraded them to a hold, and Morningstar, even after lowering their fair value estimate, explicitly states the shares are materially undervalued.
The analysts are definitely split on what to make of it.
So I have to ask you, based on everything we've looked at, Is a massive tech ecosystem trading at 10x earnings the ultimate bargain? Or is this the definition of a classic value trap?
That is the defining debate for PayPal right now.
So how do you define a value trap in this context?
Well, a value trap occurs when a stock looks incredibly cheap by traditional metrics like a 10x PE ratio, but it is cheap for a structural reason.
Meaning the business is actually broken?
Usually it means the underlying business is in permanent decline. The earnings will eventually erode, meaning the stock stays cheap forever, or just continues to bleed lower.
Do the sources point to permanent decline here?
The consensus points more toward intense stagnation rather than permanent decline.
Okay, so what's the bull case?
The bull case, the argument that this is a generational bargain is that a 10x PE means the market has priced in absolutely zero future growth.
The bar is basically sitting on the floor.
Exactly. If CEO Enrique Lores can execute even half of this AI cost-cutting program, and if they can just get branded checkout to reaccelerate a few percentage points, the upside is huge because expectations are historically low.
But the bear case argues that the friction advantage Apple Pay has isn't a cyclical problem, right? It's a permanent structural wall.
That's the fear. If Apple continues to dominate mobile hardware, PayPal's most profitable button will continue to get squeezed out of the checkout flow.
And if that happens, and the AI cost savings really do take until 2027 to materialize, the stock could just languish sideways for years.
That is exactly why our sources generally point to a neutral monitor stance right now.
The low valuation provides a floor, like it mathematically limits how much further the stock is likely to fall.
But a true turnaround requires quarters, not weeks, of hard validation before it becomes a compelling buy.
So synthesizing all these sources, we are looking at a company living in a dual reality.
Definitely a split personality right now.
On one hand, they have an absolute fortress of a balance sheet. They are sitting on $13.5 billion in cash against $11.6 billion in debt.
That is a lot of dry powder.
It is. They generate massive free cash flow, even if the timing of that cash is projected to be a bit lumpy over the next few quarters. And Venmo remains an undisputed powerhouse of consumer engagement.
But the reality, on the other hand, is that the core economic engine, the branded checkout, is sputtering.
Right. To prove they are not slowly drifting into irrelevance, they urgently need that branded checkout volume to sustainably reaccelerate above that 5% mark.
For anyone analyzing this company, the upcoming Q3 2026 earnings report is going to be critical.
What specifically should people be looking for in that report?
You have to look past the top-line revenue, ignore the massive total payment volume numbers, and laser focus on transaction margin dollar growth.
The TMD.
Yes, that metric will tell you if the unit economics are actually healing.
The ultimate lie detector test. If TMD is flat, the $1.5 billion diet isn't working, and the product mix is still bleeding margins.
And if TMD is growing, maybe the new captain is finally patching the hole of the ship.
But before we wrap up this deep dive, I want to leave you with a final speculative concept that builds on everything we've just discussed.
Go ahead. What's the theory?
Well, we spent a lot of time on Venmo today, how massive its user base is, but how it struggles to pull its weight in pure transaction profit under the broader PayPal umbrella.
Right. It's trapped in that product mix.
Exactly. There are industry rumors circulating, and we should emphasize these are purely speculative rumors right now about a potential spin-off of Venmo or the broader consumer financial services arm entirely.
Oh, wow.
Yeah. We are already seeing intense pressure on peers in the fintech industry like Fiserv and FIS to divest parts of their businesses.
It is the classic activist investor playbook. When a massive conglomerate is stagnant, activists step in to unlock value by breaking up the sum of the parts.
Right, so think about the mechanics of that. If PayPal were viewed not as one massive, struggling ocean liner, but as a collection of separate, highly specialized startups, would the individual parts be worth more broken apart?
That is a fascinating thought experiment.
Imagine Venmo as a standalone, agile social payments giant. Imagine Braintree as a standalone processing titan freed from PayPal's corporate overhead.
And classic PayPal remains a legacy checkout tool.
Yeah. If the sum of the parts is worth more than the whole, what does that mean for the future of these massive, all-in-one financial ecosystems we've relied on for the last decade?
Are we witnessing the end of the all-in-one tech monolith?
Exactly. It forces us to ask a difficult strategic question. Is the synergy of an all-in-one ecosystem actually an advantage anymore, or is the corporate bureaucracy holding individual innovations back?
In a world of frictionless digital finance, agility might be worth a whole lot more than scale.
It is definitely a structural shift to keep your eye on. So The next time you encounter that PayPal button online, or you use Venmo to split a dinner bill, remember the massive, highly complex economic engine grinding away behind the scenes.
The engine is moving $500 billion, but the captain has a lot of structural patching to do below deck to ensure the unit economics actually make sense.
We'll be watching the upcoming earnings to see if they make it safely to port.